Welcome back to Accounting with Madam Mumbi. So this is a continuation video for statement of cash flows or cash flow statements. If you have not watched part 1 of this video, be sure to watch that first to be able to understand the key concepts in cash flows, the key activities in cash flow statements, the importance of cash flow statements. Because in this video, which is part 2, we are only going to be computing a second question on cash flow statements. And specifically, we are going to be looking at this question that reads as follows. The following is the income statement and the statement of financial position of Excel Limited for the year ended 31st December 2017. The income statement for the period ended 31st December 2017 is given there. We can see there is the revenue of 42,000, cost of sales of 28,000, gross profit of 14,000, operating expenses, specifically selling and administration cost of 8,800, and a profit before tax of 5,200. The income tax is of 1,560. Finally, you have a net profit, which is after tax, of 3,640. That is the income statement. Also in our question, we are given the statement of financial position. The statement of financial position is a comparative. It is given for 2 periods. That is, you are given for the period ended 2016 and the period ended 2017. We can see that the first item is the property, plant, and equipment. The property, plant, and equipment, they are increasing from the year 2016, increasing from 16,000 to 19,200, an increase of 3,200. We can evaluate that in terms of cash flow. The first and important point to note is that property, plant, and equipment are long-term assets. Therefore, the purchase of the long-term assets or the disposal of long-term assets falls under investing activities. That is discussed in video 1. So the PPE are increasing, meaning there was a purchase of PPE, and the purchase of PPE was of an amount of 3,200, reflected by the difference between 16,000 and 19,200. Being a purchase of PPE, that reflects a cash outflow. It means that there was an outflow of cash in the organization. Because you purchase, you get the asset and the money decreases. So that is a cash outflow. The second item we have is the accumulated depreciation. The accumulated depreciation is also increasing from the beginning of the year to the end of the year. And again, I'm saying beginning of the year in reference to the year 2017, because the closing balance for 2016 shall be the opening balance for 2017. So when I say opening balance or beginning of the year, I am referring to this column which closed 2016 and which shall be the beginning of 2017. So the accumulated depreciation has also increased by 1,700. That increase in accumulated depreciation is reflective of the depreciation charge for the current year 2017. That is how much depreciation was charged in the year 2017. The depreciation that was charged in the year 2017 is 1,200. That does not represent a cash flow, because as we said in video 1, depreciation is a non-cash item. So we are going to make it as an adjustment in our cash flow statement. So the next item is inventory. We can see that there is an increase in inventory. There is an increase in stock. And stock, account receivables, accounts payables, and other payables are all operating activities. As we said, they result from the daily or the day-to-day normal activities of the business, where the normal activities of the business is buying of stock, selling of stock. They receive money from issuing of services or selling commodities. They also spend money on purchasing of inventory. So if we look at the inventory, it has increased, meaning there was purchase of inventory. And the increase in inventory means that there was a decrease in cash. So that is an operating activity which represents a cash outflow. So we are going to be subtracting the increase in inventory. The accounts receivable has decreased. The account receivables represents the people who owe money to the organization. So the amount that was owing at the beginning of the year was 4,800. The amount that is owing at the end of the year is 4,540, a decrease in the amount that is owing to the organization, meaning some of the debtors paid during the year. So we must have received money from the debtors during the year because the amount that we are expecting from them has decreased, and we received an amount there of 216. The cash at the beginning of the year is given here as 4,400, and the cash at the end of the year 2017 is 6,000. These two figures represent what we are going to use as our balancing figures at the bottom of our cash flow statement. Coming now to the equity and liabilities, we are going to start with the ordinary share capital. The ordinary share capital has increased by 1,260. That means that there was issue of shares. Shares were issued to the public, and we received an amount of money equal to 1,260, which is the proceed from the issue of shares. That is why the share capital has increased. And that one is going to be a financing activities, because we said again in video 1 that we issue shares to finance a business. We issue shares to get the money that is required to launch and sustain the business. So that is going to be a financing activity. Looking at the retained earnings have also increased. The retained earnings have increased, and they have increased by an amount equal to 3,640. And these retained earnings, again, as we discussed in video 1, we said that the increase in retained earnings is as a result of the profit that is carried down, or the profit that remains after you have paid taxes and dividends. So the money that remains after you have paid dividends and taxes is added to the retained earnings. So during the year, they must have added 3,640 of the amount that remained after paying dividends and taxes to the retained earnings. That is why they have increased from 4,200 to 7,840. And that amount is given above. You can see it is the one that is given here as the net profit after paying for income taxes. The 3,640 given on the income statement. It is the one that is causing the difference in the retained earnings. And there is no cash flow. Cash flow, there has to be money leaving the organization, or there has to be money coming into the organization. So for the retained earnings, there is no cash flow. Then you have 10% debentures. The 10% debentures of 2,000 have now been terminated to zero, meaning there was a repayment there of the debentures. We had a loan of 2,000. We no longer have a loan at the end of 2017. That means that there was a repayment of loan of 2,000. The other payables have increased, meaning that we have continued to buy from suppliers without paying. Meaning that our amount that we have borrowed by way of buying goods on credit or any other borrowing, because it's called other payables, we have continued to borrow externally. So the amount that is borrowed is of 900, which is the difference between 1,000 and 1,900, and that represents a cash inflow and operating activities, because the money is coming in because we have continued to borrow. The accounts payable have also increased, meaning we have continued to buy goods on credit, withholding money and not paying to suppliers. So again, that is a cash flow and operating activity. And finally, we have the tax payable. For the tax payable, we are going to do a working, because it means that at the beginning of the year, the tax that was not yet paid was 3,400. And the tax that is not yet paid at the end of the year is 2,940. But also, looking at our income statement, you are going to realize that there is another tax that has been charged during the year of 1,560. So for this, we have to determine how much tax then was paid. So because of that, we are going to start with that as our first working. So additional information says that depreciation is treated as a selling and admin cost. So the depreciation that we have said is of 1,700. Here, the depreciation there of 1,700, it means that this depreciation is included in the income statement. It is included in the figure of 8,800 given as selling and administration cost. So the figure of 1,700 of depreciation, it is included. It is part of what was subtracted under the selling and administration cost as 8,800. It is inside that figure, meaning we are going to be adding back the part of depreciation because it has already been subtracted as an expense. So looking at our question, it is asking us to prepare a statement of cash flow for the year ended 31st December 2017. That is what we are going to do. Remember, we said in video 1 that we are going to start with the net profit before tax. So we are going to start with the net profit before tax, and we are going to prepare a cash flow statement. So our cash flow statement is going to read as follows. Statement of cash flow or cash flow statement for the year ended 31st December 2017. And we are going to have 2 columns. And we have said we are going to start with the net profit. Net profit before tax. The net profit before tax, which we have seen is 5,200. That is our starting figure. We agreed in video 1 that we are going to start by making adjustments. So we are going to do adjustment for non-cash items, the items that do not represent cash movement. And the first one is depreciation. We have said that the depreciation was subtracted in the income statement as a selling and administration cost. It was included in the figure of 8,800. But we know that the specific amount of depreciation out of 8,800 is only 1,700, 1,700, which we saw, or we are getting that 1,700 from the change in accumulated depreciation in the year from 11,000, not from 11,000, but from the change in depreciation from 6,400 to 8,100. That is why we are getting the depreciation charge for the year. So we can proceed. After this, we are going to put cash flows from operating activities. Cash flows from operating activities. We said that operating activities affect the current assets and the current liabilities. Specifically, we have seen that our operating activities in our question, there is a current assets. Let's start with the current assets. There is inventory, and inventory is increasing. There is increase in inventory. The increase in inventory is from 2,400 to 3,200, an increase of 800. There is a decrease in receivables of 260. Those are the first two for the current assets. For the current liabilities, there is other payables. There is an increase in payables of 900. There is an increase in accounts payables of 300. Those 4 items are going to be the operating activities. So I can write all of them as we have seen in the question. We have said that there is an increase in inventory. The increase in inventory is of 800. There is also a decrease in receivables of 260. There is also an increase in payables, in other payables, an increase in other payables of 900. And finally, there is an increase in accounts payable of 300. So those are all the operating activities. So for each one of them, we have to determine whether it is a cash inflow or a cash outflow. So when inventory increases, it means that money was spent to buy inventory. Money was spent to buy inventory, so there was a cash outflow. When receivables decrease, the people who owe us money have paid. That is why now the amount that is due from them has decreased. Means we have received money from the receivables. So that one we are going to add. When there is an increase in payable, it means we have continued borrowing. When we borrow, we get money, or we get commodities that are equal to cash. So for the payables, we are going to add the increase. So out of all these, we are going to compute the sum of all these shall be the net changes, net cash from operating activities. So the net cash from operating activities, it is the sum of the negative 800 plus the other 3. You're going to get that as 660. And that is it for operating activities. We can go to financing activities. So we have cash flow from investing activities. And we said in video 1 that investing activities are activities that affect non-current asset, or they affect fixed assets. So again, coming back to our question, we are talking about the activities that are affecting the PPE, the plant, property, and equipment. So we are talking about the activity that changes the PPE other than depreciation. And we are saying that there was an increase in PPE of 3,200, which represents a purchase of the PPE. So we can say that there was purchase of PPE. So we are going to say that there was purchase of PPE, purchases of 3,200, and there is no other activity. So allow me to place it up there because there was no other activity. And when you purchase, what happens to cash? When you buy plant, property, and equipment, the cash goes out. There is an outflow. So we are going to subtract. This reminds me, at this point, after getting the cash from operating activities, we should less the tax that was paid. You should less the tax that was paid. And for the tax, we said we are going to do a working. So let me show you what we are going to do for the working on tax. We are going to open a tax account. Because there are so many issues about tax, we saw that at the beginning of the year there was a tax that was payable, or there was a payable tax that had not been paid as at the beginning of the year. The tax that was not yet paid at the beginning of the year was 3,400. That is the balance given on 2016. Then as at the end of 2017, we are seeing that there is tax there that is not yet paid of 2914. Tax that has not yet been paid at the end of the year. Then according to the profit and loss, or the income statement, we are seeing that they charged a tax of 1560 during the year. That is the tax that was charged during the year according to the income statement. So the total tax, had not been paid at the beginning of the year, 2017. This is the tax for the year 2017. So the total tax that is payable the one that had not been paid at the beginning of the year, the one that is for the year according to the income statement. The total tax that is payable is 4960. But we realize that the tax that has not yet been paid, that is payable at the end of the 2017, is 2,940. So then you ask yourself, working backwards, how much tax was paid? You compute how much tax was paid in the bank. So the tax that was paid in the bank is 4960 minus 2940. Working backwards, you subtract, and you find that the tax that was paid was 2020. This is the tax that was paid during the year. And now maybe you're wondering, where did these figures come from? These were given in all of them in the question. So you can see them there. You can see them here. That the income tax payable. The income tax payable at the beginning of the year was 3,400. It was payable, meaning it had not been paid. It is a liability. At the end of the year, the tax that has not been paid is 2940. And the tax that was for the year, the income tax expense for the year, was 1560. So this is how we compute the tax that was paid. And now we can come back to our cash flow and say that the tax that was paid, we are going to place there is 2020. The tax that was paid, and it is an outflow because payment of tax is an outflow. So we are left with the cash flows from financing activities. So we have cash flows from financing activities. These ones affect the share capital, the dividends, and so on. So from our question, we can look and see what are the financing activities. From our question, when you look at the equity and liabilities, we can see that there is ordinary share capital. There was an increase. That is a financing activity. There was money received from issuing of shares. We said there is no cash flow from retained earnings. And we can also see there was a payment of loan because the debenture has been paid. So our two cash flows under financing activities is a change in ordinary share capital and change in the debentures. And those shall form our two financing activities. So we are saying there was a proceeds from issue of shares. The share capital has increased, meaning we received some money by issuing some shares. So this one is an inflow. The money that came in from issuing shares is an inflow. And there was payment of loan. That was an outflow. There was payment of loan. Payment of debenture. So the debenture was fully paid. That is 2,000. That is an outflow. Money left the organization to pay for the debentures. And the net changes in cash, or the net cash from financing activity, is the sum of the two. The net cash from financing activity is going to be a negative of 740 because the negative or the outflow is more than the inflow. So when you add this column, the external column, whatever answer you get here is going to be 1,600. This is the net changes in cash. Net changes in cash and cash equivalent and cash equivalent. It is the net changes in cash and cash equivalent. At that point, we are going to add the cash at the beginning of the year. Add cash at the beginning of the year 2017. And the cash at the beginning of the year 2017 is given by cash at the beginning of the year 2017 is here. It is 4,400. The cash at the beginning of the year is 4,400. And the cash at the end of the year, which should be our answer, is also given there as 6,000. The cash at the end of the year. So those are the two figures that are going to be closing our cash flow statement. We are saying we are going to add cash at the beginning of the year, which is 4,400. And our answer automatically is 6,000 when you add, which is the cash at the end of the year. The cash at the end of the year. And that is how you prepare a statement of cash flow. That marks the end of part 2 of cash flow statements. And I hope it has been helpful. You have learned. Look out for more. And be sure to like, share, and subscribe. Thank you.